Hello there and welcome to Share Views. I'm joined here by Charlie Gibson, who's Head of Mining at Edison Research. How are you today, Charlie?
I'm bearing up under immeasurable stress.
Well, you have. You've been overworked and overpaid, as far as I can see. But anyway,
I think you're half right.
Okay, right. We'll try and guess which one it is. Right. Mining stocks have been leading the FTSE 100 higher. Clearly, in your day job, Head of Mining, you probably have a soft spot for them.
Probably true.
But what's your view, your objective view at the moment?
My objective view, I think, is that it's very obvious that it's precious metals that I think are making the running at the moment, and I honestly think that's going to continue. I think there's so much uncertainty in the world economy generally at the moment, and it is so uncertain how we're going to get out of the situation that we're in, is that the biggest question marks. There is an overriding problem with growth, and that affects the industrial metals, the more industrial metals, but the more overriding sentiment regards how the politicians and the monetary authorities, the central banks, are going to fix that problem. And I think the prevailing feeling is that there must be some sort of stimulus, and that calls into question then the value of paper money. And so that's part of the reason why I think that it's precious metals that have been making more of the running than the base metals and the industrial metals. And for the moment, I see that continuing. I don't see a solution to the global economic problems. Effectively, as far as I see it, the continuance of what started in 2009. I don't think we're out of those woods. We all look at the US economy, but there are many, many other economies around the world which are at various stages of stimulus in terms of their, Bank of England, what was it this week, last week, 2 weeks ago, saying that they were going to add to the stimulus. The Europeans talking about that. That there are other areas of the world where that would seem to be a very viable option, particularly if the Europeans and the UK are providing that lead following on from the US as well. So I think all of that plays into, it's a little bit analogous to the sort of situation that we had in the 70s, when the value of money changed quite dramatically between 1970 and 1980. It's not at all like the period from 1980 to 2001. Which was the great bear market for, in particular, gold, but metals in general, where they either went nowhere or went sideways. So I think the situation we're in, the uncertainties that are around, pertain to the value of the money and are more analogous to the 70s than they were that subsequent 20-year period between 1980 and 2000.
Okay, let's have a look at some slides. Rio Tinto.
Rio Tinto, an interesting one, I think. Obviously for years and years, this was a sort of bellwether mining stock in the UK. I remember in the late 90s, they used to regularly come up with $1 of earnings, and it was a fantastic trading stock because it just used to bounce between £10 and £14. Interestingly, they came up with a first half set of the results, and all the commentators noticed and said, well, that's the worst since 2004. Well, 2004, actually, earnings were beginning to rise. So you probably think, all right, it was a trading stock, in the late 90s between 10 and 14, and you think, all right, well, profits are on a par with 2004. This is probably roughly where the stock should be, I should think. And I think it's doing that trading thing. And to me, it looks like below £20, it's a definite buy. And as it's getting up to £25, maybe, or certainly £30, that is your opportunity to take profits.
Okay, next to Contender. Randgold Resources, one of the stars of the year to date.
Now you can see actually when you contrast the Randgold Resources graph with the Rio Tinto graph, you see that big jump in late June, and of course that is a Brexit thing, that was one of the things that has probably added $100 to and potentially more to the gold price at the moment. Randgold was one of those companies that benefited every which way round from the Brexit debate, because first of all you had the gold price going up, secondly their costs, because they're in West Africa, are basically denominated in euros, because the euro is pegged to the West African franc, and so weakness in the euro versus the US dollar is going to act to widen their margins. And then of course it had a sterling based stock price, so all three things worked in Randgold Resources' favour in that respect. So you can see the shares going up from a little bit over £60 to very close to £100 a share on that. They since came out with a set of results, their second quarter results. They were perfectly respectable. The market has got used to Randgold Resources outperforming. It's probably true to say that they didn't outperform in the last quarter, to be fair. They announced that to the market in advance, so there weren't too many surprises. There's just a little bit of profit taking there, but in my opinion, Randgold Resources, without question, the preeminent gold mining company, I would almost go so far as to say globally, and it's an expensive stock. Well, I say it's expensive if you look at it in that dollar per ounce, but actually if you look at it on sort of forward multiples, PEs, yields, EBITDAs, it's actually very much in line with the other North American majors. But in as much as you're paying a decent price for them, you're getting a good product. So it's like you pay a high price for a Rolls Royce. Well, you pay it because you're getting the good product.
Next chart.
Diamond got very different end of the scale here, but this a small junior, but it's a company that is developing the Lace mine in South Africa. The Lace is an old-fashioned. It's a kimberlite, so it's primary diamond production. It is the stuff that was discovered in 1885 in South Africa. They were all kimberlite pipes, so they go down into a little bit like a giant carrot stuck down into the earth, and that's what hosts the diamonds. So if you've got, not all kimberlites are diamondiferous. In fact, probably only 1 in 100 is diamondiferous, and not all of those are economically diamondiferous. This is one that has been known about for some time. It was closed down. Diamond Corp have reopened it. Now, there was a little bit of a disagreement with the Department of Mineral Affairs in South Africa, and because there was a fall of ground, the Department of Mineral Affairs said, right, stop mining, that's it. They have just announced that they are reopening production there. So that is that rise that you can see in August, and I suppose the point is you can see where the stock price could get back to where it was before the mine was shut down by the Department of Mineral Affairs.
Okay, we'll go on to next thing, which hopefully will come through in a second.
Caledonia, which is there now, and again you can see that rise after June, after the Brexit vote and the gold price going up. Caledonia runs a blanket mine in Zimbabwe, and what is significant about this stock, as well as the gold price reaction, is that it has been implementing a revised investment plan, what they call the RIP, and this involves putting in a central shaft to access ore below the 750 metre level. Now, 750 metres might sound a lot in terms of going underground. In mining terms, that's pretty medium depth. Right. 2,000 metres is and beyond is or 2,500 and beyond, that is deep. But 750 to 1,000 metres, that's pretty middle of the road, and anything less than 750 would be considered a shallow mine in terms of underground mine. So it's not a deep mine in that sense. It's a mine that's been going for 100 years. What's important, I think, about this is that they're getting early indications. They put in the number 6 wince. Now, what's important about that is production is now coming out, and we're getting the first indications of the quality of that lower grade, that deeper ore. And what's interesting is the low grade deep ore it's got a good grade. So the early indications are, it's difficult to say this for absolute scientific certainty, but the indications are at the moment that the ore is becoming higher grade with depth, certainly enough to support Caledonia's revised investment plan. So that, if you like, is looking like it looks like the plan is an extremely sound one. All the infrastructure's going in, everything's going according to plan. They're in Zimbabwe. We see lots of difficult headlines about Zimbabwe, but for a gold mining company, because they are dollar earners, they are, if you like, the bright-eyed boys as far as the government is concerned, because they're doing exactly what the government wants them to do, which is produce a dollar-based asset, which they then sell, and they bring dollars into the country. And Zimbabwe desperately needs US dollars in the country at the moment. So actually, as an operating environment, it's very much a case that they have the government on side at the moment.
It's quite unique in that way.
It is quite unique.
As is the dividend, I presume.
And actually, it is one of the best dividend payers as well. So this, actually, you can buy relative to its production, relative to its resources. This is one of the cheapest operating mines that you can buy. And of course, part of the reason is because it's in Zimbabwe and people perceive there to be a political risk there. But actually, they might be overdoing that political risk as far as the gold miners are concerned, because they're doing exactly. And you know, geologically, in terms of the ore body, it's a fantastic asset.
Okay, let's just quickly move along. We're basically out of time. If you can just quickly give us a snippet on Anglo.
Anglo-American, it's a shame this graph only goes back to the 16th of May. I would love it to go back to mid-January, because what you'd see...
It was 225 or
you would say it was 225. And the point is, you know, this has been the share which has outperformed most in the FTSE. It's the biggest riser so far this year in the FTSE 100. And extraordinary is, you know, basically you're getting a quadrupling of a blue chip company, which is a fairly rare thing. You know, Anglo-American, they're reorganising. I think everyone knows the problems that they've had, but I think it was pushed down too low by virtually everyone's opinion. There was a lot of short interest there. That's all winding out there, and so we've had this continue and run up. You know, fantastic performance it's given us so far this year.
Okay, let's go along quickly to the all-share chart.
The all-share chart, I don't know what you make of that. You know, I suppose you've got the short and the long term there, haven't you? It seems to be on this generally rising pattern with a few interruptions as well. This is moving in tandem with all of the equity indices all around the world. I mean, surely this is a function of the expectation of stimulus. And therefore, if I was to go back, either the expectation or the reality of it is that money is coming into the equity markets. Yeah. And this is despite the fact that if you look across the States, you know, if you look at the sort of PE ratios, is the prices they do look pretty expensive to earnings. Now, if stimulus is your expectation, then I still think there are a few better places to be than precious metals. And it's one of the reasons why I like the sector.
Okay, and to finish off,
this is a graph that just shows how metals have performed so far this year. So it's a select suite of metals. If you look at the right-hand side, if you can't be bothered to follow the lines, on the right-hand side, they're ordered in the same way. So silver is the top performing, and it's the top line by the time we get to August 2016. So best performer is silver, which has outperformed gold. But basically, silver, zinc, iron ore, platinum, palladium, gold, hard coking coal and oil, actually, all amongst the best performers this year. They have all given you dollar returns between 20 and 50%. Gold, because of Brexit, because of stimulus, retiring expectations of US interest rate hikes. So that, if you like, is the benchmark. Interesting that we've seen the PGMs, so platinum, palladium, they're running. Iron ore is the unexpected player there. Everyone thought that would go down. Actually, it's been strong. Zinc is the quiet one, which nobody talks about, but is the second best performer. And silver, which has this sort of geared relation, is more volatile than gold. So it tends to be that whatever gold does, silver does it as well. There are, I suppose, two other things you can observe from that. One is that there are four metals in there where industrial production, particularly China, is important. And you get two, which are the ones that have done nothing this year, and that's copper and lead. And that's where the Chinese are consumers, but not so much producers. And so what you're seeing in that non-performance is a lack of Chinese demand. In iron ore and coking coal, which have performed, what you're seeing is the fact that the Chinese, they consume a lot of iron ore and they consume a lot of coal, but they also produce it. And in reaction to the situation at the moment, what they've been doing is cutting down domestic production, and therefore a lot of Western investors who thought that these would fall or not perform at the beginning of the year have suddenly had to reverse their position, because actually these have been amongst the best performers. And then finally, you've got uranium, which has been having a miserable time and continues to have a miserable time. Yes.
All right. Well, on that note of misery for uranium, but joy for everywhere else, Charlie Gibson, Head of Mining, Edison Research, thank you very much for giving us your insights. We'll be back after the break.